next year. And the same is true for pressure on wages. But it is still most likely case that supply side constraints, as they eventually will, and as job gains move back up, inflation will move back down closer to our 2% goal. In the meantime, the risk is that when high inflation will begin to lead price and wage setters to expect unduly high rates of inflation in the future. And if we were to see a serious risk of inflation moving persistently to higher levels, we would certainly use arts to preserve price stability, while also taking into account the implication of our maximum employment goal. We therefore need to make sure that our policy is positioned to address the full range of plausible outcomes. We'll be watching to see whether the economy is evolving and with expectations, and our policies will need to adapt accordingly. We are on track to begin a taper of our asset purchases that, if the economy evolves broadly as expected, will be completed by the middle of next year.
Thank you so much, Chair Powell. Governor Cañago, you've warned of upside risk to inflation outlook. Is this an adjustment of supply to the changes in patterns because of the pandemic, or is it something that could actually stay in the longer term?
Thank you, Francine, for facilitating this, and thanks for Jay and Augustine for joining the panel. I think that from an emerging market perspective, getting into the pandemic, what we didn't have is the problem that the developed economies had, which were struggling to get inflation up. And yes, you had the COVID shock, and in the midst of the COVID shock, what you then had was that there was a shock to the inflation, and many emerging market economies found themselves with fairly low inflation during the shock. As the economies were opening up and vaccinations were taking place in the developed world, you saw that economic activity was resurging, and coming out of the lockdowns, those supply constraints started to be binding. When inflation started to rise in the developed world, it looked like the emerging markets, this was not about to happen, but it was a matter of time before it caught up. Because if these constraints were in the global supply chains, these prices will eventually transmit. And as the situation stands now with what is happening with energy prices, what is happening with the food prices, you are going to see that inflation is going to go up. And for the emerging markets, though, is that this might be combined with a depreciation of currencies. And when you have that with a depreciation of currencies, then inflation could be going up. And of course, the other is that as the developed world normalizes policy, there is bound to be a realignment of exchange rates, and there is got to be a repricing of financial assets. And all of those are also going to fit themselves into the inflation outlook. The policy response, naturally, is that you see through those shocks, which means that a judgment about whether the issue is transitory and whether there is persistence becomes important. And that is where judgment comes in, and you take it from there. The judgment at the moment is that it is transitory. And should we see any sign of persistence, policy is bound to respond to that.
Mr. Carstens, if you look at some of the economic conditions and the outlook in general, is it definitely improving? If you leave inflation to one side, even as we're going to the winter months, is it improving?
Yes, definitely. I think it's improving. I think that we are building up on the different signs of strength that have been out there since the middle of last year. I think one positive aspect is that financial markets have been working well. I think that the performance of markets has stabilized. Another very important sign is that in many latitudes, we have seen that the corporate sector has been quite strong. In many places, the earnings of some corporations have been strong. A fear that we had last year was precisely that we were going to have a liquidity problem and then a solvency problem, which meant that there was the possibility of firms to go into bankruptcy, but we really haven't seen that. And also we have seen very strong demand performance, as some of my colleagues have said. So far, I think so good. I think that what we need to focus in now or in the months and years to come is that we need to understand much better how aggregate supply works, and in some cases try to identify what could we do to make the global economy less prone to this type of supply shocks. I think we have done a very good job in terms of managing aggregate demand, mostly through fiscal and monetary policy, but more work needs to be done in terms of aggregate supply. And I would add to that the necessity to preserve open borders and to preserve free trade, because I think that it's essential that goods and services flow well in the global economy.
Thank you so much. Chair Powell, I want to ask about the outlook for policy, but I also want to make sure that your connection is crystal clear, because we had a couple of issues in the last couple of minutes. But you said last month that the process of scaling back the Fed's asset purchases could begin as early as your meeting in early November. Since then, the data has been a little bit mixed, with the employment report for September coming in weaker than expected. So do you feel that the taper threshold has actually been met for the next meeting, or do you still need more time to assess how the economy is actually coping with the Delta variant?
So I said, I guess as you had an audio and maybe didn't hear, I think that we are on track to begin April of our asset purchase. And if the economy as expected will be completed by the middle of next year, and that means that for substantial further progress toward both of our goals, maximum employment and price stability, will have been.
Yep. Chair Powell, I think we need to reconnect with you. I understood what you said, which is you're on track, but we'll reestablish the connection and get back to you very shortly. Governor Kaniago, how should central banks actually respond to the inflation outlook? Is there a risk at the moment of really falling behind the curve?
That is a possibility, but we got to make judgment. And we have so far done very well. And I think that we must accept that policy is executed in a very uncertain environment. And as things stand, our take is that our stance is appropriate for the current environment that we are having and given the outlook. But there are risks on the horizons. And in our previous policy meeting, we spelled out those risks, and those risks have to do with energy prices. They have to do with some domestic factors, which has to do with the pricing by utilities, and they have to do with the risks to the realignment of exchange rates and what could actually happen with exchange rates. And if all of those things combine together, you are going to have a serious problem of inflation actually materializing. Should there be a risk that the rise in inflation is persistent and not transitory, there is no question that policy will have to adjust. Whether you are behind or ahead of the curve is always going to be a judgment call. It's never an easy thing to do. But what you can't do is to act preemptively or hastily in a manner that chokes the nascent economic recovery. But that said, we must also be cognizant that if inflation, the rise in inflation brings persistence, it's important that policymakers act with resolve.
So, Mr. Carstens, what could be the consequences actually if central banks fall behind the curve? Sir, I think you're on mute. Perfect.
Hello. Do you listen to me?
Yes, we can hear you now.
Can you? Excellent.
Yeah.
No, first of all, I don't think that central banks will fall behind the curve. I think it's something that in the recent months, markets and many analysts have forgotten is that the track record of central banks in terms of fighting and preserving inflation has been very, very good. And this is a very important comment in the light of this forum where we are talking about the South African Reserve Bank 100th anniversary. I think if there is a country that exemplifies how successful can be the fight against inflation, is what the South African Reserve Bank has done. They have been very successful at anchoring inflation, inflation targeting and so on. And as you have heard from Lesetja, they're pretty much on top of the issues. It's a difficult time. I mean, we knew in the different central banks, in different type of central banks, that it's difficult to think about the next steps because there are very important trade-offs that need to be taken into account. The central banks will need to be very sure that we're really fighting definite inflationary pressures, because otherwise the risk would be to probably affect the recovery unnecessarily. I mean, I think also some of the problems that could present themselves even in the remote case that some central banks would fall behind would be to have some consequences on financial stability and asset pricing. But at the same time, I have to say that central banks have been pretty much all over the place, and particularly in advanced economies, have been very skilled in trying to explain to the markets and present to the markets what they're seeing ahead of them, and how are they planning to, and when are they planning to adjust their use of the instruments. So to mitigate some of the problems of falling behind, if at all, I think forward guidance is tremendously useful and powerful.
Thank you so much, Mr. Carstens. Chair Powell, one of the points, of course, made by critics of the Fed's implementation of the new monetary policy framework is that because the committee risks tightening rates too late until you all are confident that labor market is well past full employment, you may then have to do more when you start tightening. So this risks an increased chance, I guess, of a recession. How do you respond to that?
The basic misunderstanding of our framework. Our framework, if you go back and look at it, was designed to deal with the case where labor markets got tighter and tighter, but inflation didn't react. That's the situation we've had for a number of cycles, particularly the last one. This is a very different situation, and the situation now, of course, is that we're still 5 million jobs below the level of 2020 at maximum employment. At the same time, inflation is not moderate, but well above target. So it's not the situation that sort of patient approach was specific and clearly designed for. This is a different situation. This is a situation in which the two sides of our mandate are somewhat in tension, and we actually covered that in our framework. And what it says that when the two goals are not complementary, ordinarily when inflation is high, that means tight labor market, and when inflation is low, that means a lot of labor markets like this. This is where you have labor markets slack presence of high inflation. What we do is we take into the employment shortfalls and inflation deviations, the potentially different time horizons over which employment and inflation are projected to return to levels consistent with the mandate. So that's what we will do. It's a misunderstanding of our framework. But let me say, to your point of being late, employment 5 million below where it was before the pandemic. If you say, well, how far is it below trend? Job creation actually 7 million. Nonetheless, the labor market is very tight by many measures, and partly because it's taking time for workers to find new jobs, and because many people are hold of work for now due to COVID. So while the time is near tapering our asset purchase, it would be premature to tighten policy using rates now, the effect and intent of slowing job growth when there's good reason to expect a return to robust job growth and for the supply constraints to diminish, both of which would have the effect of increasing potential output of the economy. Now that said, of course, I do think we need to be, but we also be watching very carefully, and that goes back to what I said earlier. Ourselves in a position where we can address the full range of plausible outcomes, and the tape gets us there.
Mm-hmm. Thank you so much, Chair Powell. Governor Cañago, after such a prolonged phase of exceptionally easy monetary conditions, do you actually expect it will be possible to exit from such a stance without causing disorderly market reactions?
It is possible to exit. I think that what we need to be clear about is that the exit from these policies is not going to be time dependent, but rather that it is going to be state dependent. And so central banks have got to be able to assess the state of the economy, the risks to the inflation, and respond appropriately. And different central banks will be faced with different situations depending on the extent of the stimulus that they had done and the initial conditions from which the exit has got to take place. Second issue is that as you plan to exit, the point that Augustine had made earlier on, that it is important that there is clear communication about the nature of the exit. And I must commend Jay here and his team at the Fed, because I don't think that we have got a risk of a 2013 taper tantrum. The communication from the Fed over the past few years have been exceptionally better than what we had seen in 2013. So exit, yes, we will exit, but I do not think that the exit will be a disruptive one.
Thank you so much, Governor. Chair Powell, I have quite a lot of questions for you with just a very simple question, and I hope we can hear you well, because sometimes it's hard of hearing because of the connection problems. I'm sorry about that. It's a very 2021 kind of problem. But I'm getting three questions saying, are you absolutely certain, Governor Powell, Chair Powell, that the Fed is not behind the curve?
I think don't live in a world of absolute certainty in the economy or in monetary policy. I would never say that. Anything in part of the job that we do. So I think the way I would think is this: we have a base case, and that base case is that we see with our own eyes that these supply constraints are directly connected to pandemic-related issues. So we see that, and we think that global supply chain will resume function over time. We have a very time knowing we don't know how long that will take. So, and that's really into the strong demand we're seeing is causing the high inflation. So the risks, so that's your base case. It's very widely among macroeconomic forecasters, very widely. Risks are clearly now to longer and more persistent bottlenecks, and thus to higher inflation. So we now see inflation and the bottlenecks lasting well into next year. So we live in a risk management business, not one of absolute certainty. I would say that our policy is well positioned to manage a range of plausible outcomes. I do think it's time to taper. I don't think it's time to raise rates because, as I mentioned, I just said it would be premature to do so at a time when we're far below the level of jobs that we had in 2008, and particularly if you adjust that for the trend. Again, we need to watch carefully to see whether the economy is evolving consistently with our expectation and adapt our policy accordingly. And that is what we will do.
Mr. Carstens, do you think the new monetary policy frameworks are fit for purpose?
Well, I mean, I definitely think that they were done following a very thorough research and consultation by the main central banks that have done so. I think that they are adjusted to the needs and challenges for the future. Yes, so I think they're appropriate. I think something that was needed is a fair, the adequate amount of flexibility. So I think, for example, the issue of following average inflation is a good change. The adjustment that has been done to the European Central Bank framework also, I think it's adequate to have a more symmetric tolerance for deviation. So I think, as always in monetary policy, there is constant evolution. I think that the different frameworks have been evolving to time, adjusting to the recent experience, adjusting how markets behave. So I definitely think not only the adjustments to the frameworks have been adequate, but the other thing I have to talk very highly of is the process that has been followed in the different different central banks to do this with plenty of consultation, with very good openness to hear different opinions from academics and markets. So I feel that it was timely and it was adequate.
Chair Powell, thank you, Mr. Garson. Chair Powell, how will the Fed act if inflation looks to be an anchoring before full employment is actually reached?
As I read that, we have a specific section of our framework that causes us to balance two goals to ask how quickly we move back to target and how far they are from it. But also, as I said earlier, if we were to see a serious risk of inflation moving up consistently to higher levels, persistently that is, we would certainly use our tools to preserve price stability while also taking into account the implications of our maximum employment goal. No one should doubt that we will use tools to guide inflation back down to 2% over time. At the same time, now we think we can be patient and allow the to take place and allow the labor market to heal. We expect it to resume doing fairly shortly. As you recall, over last June, July, we were having something like close to 9,000 new per month, which is a nice pace. And if we like anything close to that, then we will very quickly be absorbing remaining slack. We'll also be monitoring inflation very carefully, though, as mentioned, and adapt policy accordingly.
Thank you so much. Governor Cañago, to what extent is Fed tapering actually likely to affect the SARB's interest rate trajectory?
It's a fairly straightforward one in terms of the channels that you can identify. But whether the things pan out in the manner in which you think about the channels is a different ballgame. To the extent that the Fed tapering is taking place because the U.S. economy has recovered and is strong. A strong U.S. economy is good for the world economy, and as such, that should be seen positively. Secondly, is that what we would have seen is that with the strong recovery in the U.S., the growth differentials are actually in favor of the U.S. And so if capital has to be changing direction, it is likely to be going in the direction of the U.S., driven by the growth dynamics. What is in no doubt is that with the tapering taking place, bond markets are going to have to readjust. And when those bond markets readjust, starting with the U.S. Treasury market, bond markets around the world are going to readjust, and with that, also a movement of capital. And thirdly is that when that happens, we expect that there will be a realignment of exchange rates. And just thinking theoretically, if the growth differentials are in favor of the U.S., then it goes without saying that a realignment of exchange rates could involve an appreciation of the dollar against the other. And so that will feed itself, and different countries moving from different states will have to respond differently. And so in the case of South Africa, if we looked back to where we were in 2013, we are less vulnerable than we were in 2013. We are not invulnerable. We are just less vulnerable than we were then. We will be getting into these adjustments with a fairly strong balance of payment position. We are in a current account surplus at the moment. That will unwind over the next 2 years or so. We had benefited from a commodity boom, temporary as it may be. That gives the space for the government to do a fiscal consolidation faster than they would have otherwise had. And of course, the risk there is that when these adjustments are taking place, we have got two risks. The first risk is that globally we are going to have to get treasuries to be wind of cheap money, because at the moment you have got low bond yields, the cost of borrowing are very low, and whether the treasuries are using that space to make the necessary changes that has to be made remains to be seen. The biggest policy mistake would be for the treasuries to pretend that this is a permanent situation and it could turn out to be a very costly affair for the treasuries if it was to happen in that manner. So, with all of those things all taking place at the same time, the position that we would take as South Africa, and I'm sure every other country will assess this, is to look at what does this mean for the growth outlook, what does it mean for the inflation outlook, and what is a reset of the policy stance that must take place. The first round of these things is going to be a challenge because we've got to take a view about, once again, whether this is transitory or whether there is going to be some persistence. And so we would have to take a call that says, as usual, we look out for the risks to the inflation outlook, we look for any presence or emergence of second round effects, and then adjust policy as appropriate.
Thanks so much. Mr. Carstens, do you agree with that? Or anything to add?
Yes, pretty much I agree with that. You know, my friend Lesetia, we share many experiences, common experiences, and the way he presents things reminds me my time as a governor of Central Bank of Mexico, because yes, emerging markets face particular issues, in particular dealing with, global financial conditions, and well, of course, global financial conditions are quite influenced by the decisions that they naturally so that the Federal Reserve take. There are other important issues to determine the financial conditions emerging markets face. In particular, that's the development of their exchange rate. And there, of course, local issues also play a very important role. So yes, I mean, I think that the presentations by Lesetia have reminded me of my good old times as a governor of Banco de Mexico.
Thank you so much. Chair Powell, how would you describe actually the Fed's relationship with markets right now? Like, what are they misunderstanding?
Well, so here's the part of we control, and it's our own communications. And as I think you're hearing, and as people know, try to be as transparent as possible and as clear in our communications so that markets will know how we will react. That's what our baseline expectation is, but how we'll react to the inevitable deviation from our baseline expectation. And we really do focus on that a lot. We do not set out to eliminate all. I mean, the markets have to adjust as the economy adjusts, and part of the way adjust, not all of the way, but some of the way that is through what central banks do and say. We don't set as a goal, nor should we. I think, to eliminate all. We're never going to be perfect in this, and it happened. For example, the pandemic, we have to react really quickly. So it's not possible always to clear ahead of time. So, I mean, funny, I think our policy is in a good place. I think the market generally understands, where we are and going on. I'm not blessing every asset price or anything like that, but I feel like we've communicated certainly. The main focus now, of course, is on taper, and I think the communication on that has worked. We all lived through 2013 and the taper tantrum, and kind of have gone out of our way to avoid this time. I think so far so good, and that's what we're going to continue to do. We're very, very mindful of the effect of U.S. financial conditions on financial conditions around the world and on economic conditions too. So we try to communicate carefully.
Thank you so much, Chair Powell. I have a couple of questions actually coming in from people listening in. Governor, let me ask you this. Are there technology changes, and this comes from someone actually listening in, for Governor Kaniago, are there technology changes associated with the pandemic and how businesses are adjusting to it that will change the way that central banks see inflation coming out of the labor market?
Thanks, Christine. There is no doubt that technology changes is going to affect the manner in which we assess economies, not just inflation. What we have learned from this pandemic is that we do not have to all be working in the offices, that we could be working remotely. And Augustine was telling a story some other time of his German teacher who is actually located in the US, and Augustine is in Switzerland. And the German teacher in the US is costing a third of what Augustine should be paying in Switzerland to learn German. Now that changes the dynamics of the labor market completely, because that means that people are able to source labor wherever it is cheapest. That's the first point. The second is that, of course, with the technological progress that you would have seen, it changes the relative prices of the factor markets between labor and the rest of the factors of production. That poses a very important challenge, and the challenge thus is not just for us as central banks, but it is also for the broader government authorities about how we are going to look at this evolving world of work. You're having a changing world of work, and with that changing world of work, labor dynamics are different, and it is a challenge that we are all going to be facing. But I would be interested to hear what the other two panelists have to say, in particular, Jay, given the scale of technological change in the US.
Chair Powell?
Well, so I agree with what Les just said. I would just add this. What technology does is it raises productivity. So Augustine's German teacher at a university in the Midwest can be much more productive too, and so can Augustine. And that teacher can have students all over the world, and the teacher isn't driving to places, and it's so much efficient. So, but what technology demands is that the public have skills and aptitudes that put them in a position to benefit from it. And that's an issue. And so what one of the reasons behind growing inequality in many countries, certainly in the United States, jobs we're doing we're going to be either less well paid, or smaller pay increases, or they'll be automated away, or they'll be somewhere else in the world. So what that comes back to for me is the need to make sure that the population, that everyone has access to education and kind of training that they'll need to benefit from technology, which of course does increase productivity. It's nature in many cases. Leaving aside social media there.
Yeah, thank you so much.
Increases productivity.
Thank you so much, Chair Powell. Mr. Carstens, I mean, first of all, everybody wants to know how your German is getting along, but the second question is probably, will this change the way that you see economic slack?
No, my German is much better. Certainly, it allows me to have more classes at a decent rate. I have to say I also have a Swiss professor, so I have both. I'm very intense in German right now and making substantial progress. I mean, let me add one important thing, because we're here talking also in the example of South Africa, and I think and I want to thank, in particular, Jay Powell to be with us today. He has always shown tremendous interest in African countries. He has joined us in other events at the BIS with the African representatives, and it's great to have the opportunity to have him here in this fora. But one very important issue I think that many emerging markets and developing countries face is the fact that the pandemic has affected a lot the attendance of kids to school. And let's face it, I mean, in many emerging markets, developing countries, the availability of technology is not there. And oftentimes also technology doesn't work absolutely perfectly. So it will be a huge challenge for all the world, but in particular emerging and developing countries, to make this catch up so that we don't have generations of youths that will be handicapped in the future, given the lack of education that we will have had already for a couple of years. Now, in terms of what is the slack in the economy and so on and so forth, I mean, I think that the key issue here is the fact that in the short term we will be facing many different conflicting signals. And part of that has to do precisely with the dislocation of markets that are being presented by the recovery out of the pandemic. We see part of that reflected in relative price changes that has been affecting our reading of inflation. But at the same time, we also see that in some cases we see rising unemployment, but also bottlenecks in terms of lack of skilled labor in some very specific sectors. So it will take some time before we manage to have an adequate world in which the degree of slack also corresponds to not dislocations in markets, in particular in the labor market. So we need to focus also in the labor market to see that we don't have, unnecessarily bottlenecks there.
Thank you so much. I have a question actually for Governor Kaniago on South Africa. How do you reconcile wanting to lower the inflation target with the fact that your economy needs as much support as possible to strengthen recovery prospects?
Having a higher inflation target is not going to give South Africa higher growth. Higher inflation begets higher interest rates. And South Africa's inflation target is out of line with those of peers. It is something that South African policymakers recognized as early as 2001, and that it had to be lowered, except that for some reason we forgot that it had to be lowered. Over the past 5 years, South Africans have benefited from low interest rates, and they benefited from low interest rates precisely because the South African Reserve Bank has been able to contain inflation. And this is not the time to drop our guard. We were able, in the middle of the pandemic, able to provide support to this economy. And the reason we were able to provide that amount of monetary stimulus was precisely because we had built policy buffers and we had contained inflation, and thus we were moving from a much stronger position than we would have otherwise have had. South Africa had previously experienced very high inflation, and those periods of high inflation coincided with very low growth. So the notion that South Africa could inflate its way to growth is not backed up by the reality of our experience.
Thank you so much. Chair Powell, I have a question. I think you answered part of it a little bit before, but I just want to make sure that everybody is crystal clear on what you said, given some of the connection problems. Secretary Yellen said this Wednesday that actually she still expects the U.S. economy to return to full employment next year. Do you share that confidence? And you also talked about wage price spiral at Jackson Hole. Are we seeing early signs of that?
So, again, my expectation is that as Delta fades and hopefully, if we begin to make progress on supply side constraints going away, that will be the service side of the economy reopening here, and growth will go to closer to the very high levels we saw summer. And so I think it's very possible that we'll be at or near conditions, labor market conditions that are consistent with maximum employment goal next year. That is possible. It's not a certainty, and there's the range of uncertainty is significant. So some of the inflation episodes we saw before inflation expectations, the low inflation that we've been in for the last couple of decades or more, some of them involved this wage price spiral, and we're seeing evidence that we are seeing wage certainly moving up, particularly for people in the lower brackets. what wage brackets, particularly in the sector. We do companies have a hard time hiring people in many parts of the economy. We don't see that evidence of that yet, and we do expect progress, as I mentioned. So we'll be watching this very carefully. I laid out a number of lenses which we look at inflation. We don't just have one way we look at inflation. I laid out a number of them, and we're looking at them carefully and as well to see that our estimate is correct. And as I said, policy will as we see more data and as we see how the economy evolves.
Thank you, Mr. Carstens. Is secular stagnation, this is a question from someone who's following online, is secular stagnation a thing of the past, and will it structurally actually change the balance of risks for central banks going forward?
Well, that's a very important question. It's a question that has more to do with the medium and long term. Certainly, there are secular trends that are still there. Some have to do with demographics, with the technical change and so on, and those I have to say are still going to be there. Therefore, we will see how things play out. In the short term, certainly short and medium term, there are issues also that playing a very important role. My own central scenario is one in which we will still have growth with the transitory inflation above target. But I think growth still will be robust in the years to come. I think that through time we will develop the ability for supply to adjust to demand, and I see demand will continue to be strong. But in the medium and long term, I think that growth is of the essence. And I think that we need to look very much into the details about how to engineer more growth. And I think that on top of the aggregate demand management through monetary and fiscal policy, we need to look into those structural reforms that can allow us for more sustainable growth. In this case, the policy to combat climate change could be an opportunity to enhance sustainable growth. But also, I have to say, the policies that are being contemplated in the U.S. to have a very aggressive infrastructure package, I think is also very, very important. Those are the type of policies that will help both in terms of the short and medium-term growth, but also in terms of long-term growth based on higher sustainable growth.
Thank you so much. It's very interesting, actually, to see. We were mentioning technology before, and I'm getting quite a lot of questions on actually the extent to which technology is changing the way central banks think. So, Governor, first of all, this person's writing in, to what extent has this changed the collection and dissemination of statistical data? And are central banks evolving fast enough to basically deal with this technological change?
Sorry, who are you asking that question of?
So first we'll go to Governor Cañago, and then we'll go to you, Chair Powell.
I was hoping it was meant for Jay. There had to be significant changes in the manner we collect. It's the issue of measuring the digital economy itself. It is a big challenge for the statisticians. They are grappling with that, but also the speed with which technology moves beggars the question. Statisticians have this thing of re-benchmarking and rebasing every 5 years or so, and whether the speed with which technological change is taking place could necessitate that they do that with more frequency than they are doing. Thirdly, is that last year when we had a lockdown, we had to assess where the economy was, but we couldn't quite assess this because the statisticians were also asked to stay at home, so they couldn't collect the data. And so we had to start doing other things. And my staff here in the Reserve Bank developed something that they called the trachometer, where they basically started to rely on the number of trucks that are going through the gantries as a proxy of some form of economic activity. And they started to use Google mobility data to look at the number of people who are going through the transportation nodes to see whether people are moving and so forth. And so there was a big challenge for us to improvise, to look at alternatives to the official statistics as compiled. And we actually found fairly interesting stuff. And a lot of central banks, we are also looking at the use of big data. And in trying to figure out these things, how to navigate through the pandemic, we are actually finding very interesting trends emerging on how we could use big data, machine learning, and all of that stuff that would enable us to actually also assess the economy faster. So the statisticians are going to be challenged. There's always big things now. This information is now almost available real time, and whether continuing to send people with forms to supermarkets and all those things trying to compile prices is the manner in which we are going to continue to compile statistics. So it's going to be a challenge for the statistical agencies. For the central banks, we do compile a limited number of statistics. We are predominantly a user of statistics rather than a compiler of statistics.
Thank you so much. Chair Powell, same question.
We've been collecting and publishing data on industrial production for more than a century. I think we just had our 100th anniversary of doing that. And it's an evolving science, and so for the last, since close to this decade, we have been working in getting large data sets, big data, private data sets that will help us understand really the current state, the current position of the economy. The idea is get a better sense of what's happening in the labor market with hiring, with wages and things like that. So we've done quite a bit, and we work with data scientists in the private sector. It's very, very interesting. But it's what we're really trying to do though is get a better sense of the current state of the economy. It's not like you get all the data and know where the economy is going to be in months with any confidence. It's just too complex and too difficult to forecast with confidence. So, but I do think we make very gradual advances in the world, and no doubt we'll look back on as the early days of big data and analytics, and we certainly pay attention to them. I'll just mention two other things as far as I'm talking about digital things. In the world of payments, digital payments is being revolutionized. All of us are spending a lot of time on that. In addition, we have the digital economy now. So you've got big parts of the economy that are digitalized, and that's interesting implications. And it's a fast evolving economy as retail move more online, things like that, which we're constantly evaluating. So all this area is one occupies an awful lot of bandwidth these days.
Thank you so much. Governor Kanyaga, I want to ask you about the outlook for capital flows into emerging market economies. How's that looking for the rest of the year and into next year?
I think that is important to move from what the current conditions are. What we have seen is that there is a divergence in the recovery of capital flows to emerging markets. You had these massive outflows last year, and in the case of South Africa, the outflows were also driven by the fact that we got downgraded last year, and combine that with the pandemic, we experienced a massive outflow. Fortunately for South Africa, we have got a fairly developed and sophisticated domestic investor base, which was able to fill the gap. And for those emerging markets that do not have developed investment markets, they might have faced significant challenges. What have we seen? What we have seen is that when you looked at emerging Europe and emerging Asia, you see that the capital flows are recovering, and they are almost close to what they were prior to the pandemic. It's a different ball game when you looked at sub-Saharan Africa, including when you looked at South Africa itself. But a number of things also are driving these things. In the past, we have seen massive bond outflows, and this time we have seen that we had massive equity outflows. Now, equity outflows are very much related to the growth story. And in the current milieu, the growth story is very much a vaccination story. Vaccination policy has basically become economic policy. And so those countries that were able to vaccinate faster have actually also recovered faster. And most of them are actually now where they were prior to the pandemic with respect to economic growth. Whereas when you look at the countries which have not vaccinated, whether it had to do with government, whether it had to do with access to vaccines, those countries are lagging behind. And it is no surprise thus that you also then see that those are also the countries, predominantly in sub-Saharan Africa,
has been to face the normalization process. I have to say also the fact that the Fed has opened the facilities to facilitate swaps and repos in Treasury securities is a plus. So I think that the countries are much better prepared. I want to just echo one thing that Lesecha was saying in his exposition. He's back. I think a lot on not only to face the normalization process, but also this issue that we have seen already, which is outflows, is a growth story, and I think that's where many emerging markets have to pay attention. And I fully subscribe to the view of Lesecha that part of the problem is vaccination, but I also would say is policy space that is far more limited in emerging market economies.
Chair Powell, this is a question for you. How does the Fed incorporate the interactions of its actions with the rest of the world economy in general and emerging markets in particular into its reaction function, if at all?
So, of course, we all domestic demand. So it's maximum employment price stability in the United States, and that's ultimately the law. That's our goal. But financial markets are very fully globalized, and meaning that actions anywhere in the world can have enormous effects. Think of the pandemic breaking out in China, and the effect that had before it spread elsewhere, even to around the world. And financial conditions have very strong effects on economic activity as well. So you have to think, we all live in the same financial system, which is tight and are connected around the globe. The economy are also tightly woven over now, more than they were over a century ago. So we think about that a lot. We think about it in normal times, that we want to communicate clearly and markets understand where we're going. In stress times, we given the importance of the dollar in the global economy. We have ways of securing the availability of dollar funding around the world, and we use them in our swap lines and other. The FEMA repo facility, New York Fed now will serve that purpose as well. So we're very mindful that we're all living in the same, certainly the same financial system, the same global economy, and that our economic conditions here in the United States are very much affected by what goes on abroad, and vice versa. And that is kind of always the thinking, I think, for any large central bank, including the Fed.
Thank you so much. Governor Cañago, can we expect this happy marriage between monetary and fiscal policy during the pandemic to continue in the years ahead? And it also goes back to some of the questions that we're getting from people listening in which is, tied to that. To what extent do higher public debt levels weigh on economic growth worldwide?
I'm not sure that I would quite call it a marriage, but the pandemic necessitated a coordination between the fiscal authorities and the monetary authorities, and the actions reinforced each other. And the manner in which both authorities responded depended on the amount of space that they have had. And I think that the world over, you have found that central banks seem to have had more space to respond, and they responded with speed, and they responded with scale. Not the same couldn't quite be said of fiscal authorities, especially in the emerging market economies, and South Africa was no exceptions. Just 2 points that one should bring to the fore. The first one is that it is important that in that coordination between monetary and fiscal authorities, that each one of the authorities act within their remit. My fear is that because central banks have been so successful, we would then think that these institutions could be used to solve all of society's problems. And I think that that would be a terrible mistake. Second fear that I have is that because of what you have seen in the advanced economies with the massive asset purchases, which are done mainly through central bank reserves, fiscal authorities are now more sensitive to changes in interest rates. And when that happens, there might be a response that could start to challenge the independence of central banks, which we would have to guard against. And lastly, and more importantly, is that it is not just the issue of fiscal and monetary policies that it had to bring to bear. It was also financial policies. And the countries that had responded well had been those that had been able to calibrate those policies and move with speed. And what is important in a crisis is that you actually need to move with speed and then recalibrate policies as you go on, because you do not know what the nature of the crisis is, and you learn as you go along.
Thank you so much. Chair Powell, there's a question, of course, because the Fed has just unveiled a major overhaul of its trading rules following revelations by some officials last year. You've also asked the Fed's own Inspector General watchdog to examine whether trading activity by certain senior officials was in compliance with both the relevant ethic rules and the law. Is this probe by the IG still ongoing, and do you have a timeline on when these findings will be made public?
So the Inspector Generals in our system government, for our international viewer, are fully independent, have their own authority and investigate as they see fit. They're in every major sort of institution that we have here. And the timing of investigation is within the control of the Inspector General. So I can't really comment on that.
All right, we're almost out of time, so I'll ask you all just in a couple of minutes to maybe share your biggest concerns over the next 12 and 24 months. Mr. Carstens, you can kick us off, and given everything we've just talked about, what are the two priorities that both policymakers and markets should be thinking about?
Well, I think even though we have had a major progress in terms of vaccination and so on, we still are not out of the woods yet. And I think the pandemic still will be playing an important role in the near future. hopefully we will make more progress with the treatments, with effective treatments. I think that the recent news with the Merck treatment, I think, is very good. Because my own sense is that we will need to learn to live with with the virus. So I think number one is precisely to make progress with this, reduce the incidence of the virus, and allow for a normal life to be reinstated and economic activity to be reinstated. I mean, certainly depending on the development of the pandemic, different types of policies will have to be implemented. I am a little bit concerned in some countries in particular that policy space is becoming more limited. And therefore, that's why I think it's doubly important to have progress in the pandemic. And towards the medium and long term, I think that the growth story is very important. I think that we need to redouble our efforts to understand better aggregate supply and how can we get more growth into the global economy. And in particular, I'm a little bit concerned in some latitudes about the situation in the labor market. I mean, I think the central scenario is a good scenario, but we still face the issues related to the pandemic as a central actor in these next months and years.
Thank you so much. Governor Cañago?
Three things. Firstly, I think that a message to the commodity producers. The commodity boom is not a permanent boom. Like all the previous ones, at some stage, it will bust. Don't adjust your spending and pretend to be richer than you actually are. That's the first point. The second point that I would like to make is that we need growth, and growth is important. But growth is not a policy. Growth is an outcome of policies, and that we actually need to be putting the growth policies that we actually need that would lead to the kind of growth that we are actually looking for. And my fear is that this era of cheap money had actually made the other policymakers outside of the central banks to become complacent and postponed the difficult decisions that had to be made, which were supposed to have been made prior to the pandemic. And now we are faced with this, and these decisions are continuing to be postponed. And third and last is that treasuries have got to gear themselves, that the cost of funds is going to be rising as policies normalize, and they better be able to take decisions now before that time sets in.
Thank you so much. Chair Powell?
So for me, and it really is one thing, and is successful managing the economic exit from the pandemic in a highly unusual situation where effectively we're missing a piece of potential output because of the constraints and the non-full opening of the service sector. And so we want that to give full time for that to come back before we start restraining demand with interest raises. On the other hand, we see that inflation is high, and inflation, of course, affects people on more limited bits in their groceries and gas purchases and things like that. We know how painful that is, and we have to look through to work with a family along variable lag. We have to look through that and balance those two issues. And so that I think it's extremely important that we get that right. I am confident that we will do so over the course of the next year or so. I think in the meantime, it's going to be extremely challenging, certainly in the short term. Thank you.
Well, thank you all for joining us. It was a very entertaining and spirited conversation looking at how central banks, of course, globally relax monetary and financial policies to offset some of these shocks that we saw because of the pandemic. We talked about some of the policies. We talked about some of the things going forward. And of course, as much of this accommodation now needs to be unwound, I guess it's up to, well, inflation expectations to take hold and see how policymakers react to that and some of the setbacks that we could see. So thank you, all three of you, for joining us today. Thank you for everyone watching at home or in the office. And have a great day, everyone. Thank you.
Thank you, Francine. Thank you, Jay.
Thanks, Francine.
Yes, Francine.
Thank you.
Thanks, Jay. Thanks, Augustine.
Thank you.